In terms of population and economy, China has been clinching the top positions. Since 1950, the country has been ranked number 1 in the world population sheet and overtook Japan in 2010 to become the second largest economy in the world. However, recently its position on the world population sheet has been wavering as the country's population only increased from 1.41212 billion to just 1.41260 billion in 2021. A record low increase of just 480,000, a mere fraction of the annual growth of 8 million or so common a decade ago. And the economy is also affected by the COVID-19 pandemic. Now, another Asian country, the second most populous country in the world and the world's largest fifth economy, India is presumed to take the baton from China. Is India up to the task? Firstly, let's consider both China's and India's economic styles. Following its independence from the British colony in 1947, India established a centrally planned economy, also known as a command economy. In a system where the economy is centrally planned, most economic decisions related to production and the distribution of goods are made by the government. The government put all its effort into growing the heavy industry sector, but at the end of the day, this focus was considered unsustainable. The collapse of their primary international trade partner, the Soviet Union, combined with overall poor economic performance, led to the country falling into great debt. The debt is so severe that they barely avoided going bankrupt due to the last-minute loan from the IMF. Not only that, India was coerced into the adoption of the Washington Consensus. The IMF also helped revive their economy with the use of the Washington Consensus. The Washington Consensus is a set of economic policies recommended for the revival of developing countries. The term Washington Consensus is the level of agreement between the International Monetary Fund, World Bank, and U.S. Department of the Treasury on the policies. With the adoption of the Washington Consensus, India moved from a centrally controlled economy to an open economy. The open economy allows foreigners to make investments in the country and more importation of products. The adoption of this system led to the abolishment of India's economic policies, like the protectionist policies. These protectionist policies mean the levying of tariffs on foreign products in a bid to protect locally made products from going into extinction. By levying tariffs on foreign products, they became expensive for end users, so they are termed luxury goods. Through this method, the local companies were able to keep their customers. Today, India is considered a mixed economy country, a system where private and public sectors coexist, and the country leverages international trade. Meanwhile, China is far from adopting the Washington Consensus. China experienced growth in its GDP in 1952, but experienced a decline in the mid-1950s to 1970s. During that period, the country remained relatively poor due to its outdated infrastructure, a product of years of wars, an inefficient planned economy, and repeated political movements. But with the adoption of the sweeping reform and the opening up policies in 1978, the country gradually moved to a market economy and started to unleash its full potential. Today, China practices what economists call a socialist market economy, one in which market capitalism and private-owned enterprise coexist alongside a significant state-owned business sector. Jiang Zemin introduced the system in 1992 at the 14th National Congress of the Chinese Communist Party. The communist regime in China quickly realized that isolating its economy from the rest of the world would be to its detriment. Since then, they have been effective in finding a balance between the collective and capitalist approaches. The establishment of a special economic zone and the opening up to international trade has been the catalyst to the country's fast-paced economic growth, thanks to the timely and appropriate changes carried out on the socialist policies. China has not only been the world's factory, but also lifted over 700 million rural residents out of poverty with their economic growth. Now, considering the demographic factor, India has a demographic advantage that positions it to have one of, if not the fastest growing economy in the world. With a population of 1.4 billion, India's population is just a bit lower than that of China, and by 2050, India is expected to surpass China as the most populous country, with a population of 1.7 billion. With that population, India's economy should grow by 6 to 7% in the following 10 years. Furthermore, their population is relatively young, evidenced by their dependence ratio. This indicates more active manpower in the economy, supporting the elderly and young. But the big question is, will India take good advantage of this opportunity? While India's growth has been quite impressive, closely following China's, there is a problem with the utilization of that growth rate, which is slowing down the pace of their economic growth. India's workforce lacks the needed hands. Its unemployment rate is currently about 7%, and the apparent lack of employment opportunities has led to a decline in the labor force rate. However, at the end of the COVID-19 pandemic, that drop seems to be more structural than simply a result of a lack of employment opportunities. For instance, between 2016 and 2017, the labor market was as high as over 46% before shrinking to 40% in 2021 to 2022. Understandably, COVID-19 caused the participation rate to decrease significantly since the entire economy was shut down. But the participation rate increased after COVID-19, and later on, the downward trend soon returned. Interestingly, both rural and urban areas are experiencing a dip. For females, the trend in non-participation in the labor force is more positive. While in 2016 to 2017, about 15% of women were either working or looking for a job. Only 9.2% are doing the same currently. Think about labor participation rate for a moment, a situation whereby roughly 40% of the labor force is working, pointing to the hard truth of the remaining 60% of the labor force either losing their jobs or is no longer interested in securing one. Also, India's economy has shifted towards digitalization and technology, which requires a higher level of education and training. While this would have been a good step, the existing workforce seems to lack the necessary skills needed for India to transition to the digital and services-oriented economy it desires. So, due to this unavailability of low-skilled employment opportunities, India won't be able to take advantage of its demographic ability. The entry of India into high-tech manufacturing and services has a long history. The number of unicorns, a term used to refer to privately owned businesses valued over $1 billion, has increased, and this growth is expected to continue. The government seems to have prioritized high value-added manufacturing above low value-added manufacturing, which shouldn't have been so. This low value-added manufacturing helped boost China's economy and other Asian countries like Vietnam. Low value-added manufacturing is labor-intensive and doesn't require a high skill level. Seems India doesn't want to undergo this stage. They want to jump right into high value-added manufacturing. India has certainly been efficient in fostering technological advancement, as seen by Bangalore's moniker as the Silicon Valley of India. However, the general labor force lacks the skill needed for technological development. In the United Nations Human Development Index, HDI, India ranks 131st out of 189 countries, trailing nations like China, Indonesia, and Vietnam. The growing tech sector has also attracted foreign direct investments, FDI, to India, but this type of manufacturing requires highly skilled workers, which the country lacks since about 80% of India's workforce is illiterate, working in either the agriculture or construction industry. Further, the manufacturing sector has a low influence on India's economy, about 14% of the gross domestic product compared to China's 27%. All in all, India lacks light manufacturing. Seems they have abandoned it to nations like Vietnam and Bangladesh. This type of labor-intensive sector may have been filled with the Indian people, but this potential source of growth may no longer be viable. Vietnam and Bangladesh have benefited from the low value-added manufacturing, i.e. light manufacturing, which seems to have boosted their per capita income. Vietnam has a per capita income that is 38% higher than India's. Bangladesh has a higher per capita income too, but not as high as that of India. These countries have become home to many textile and clothing factories and have seen their exports skyrocket. In sum, If matching China's investment rate is India's goal, which it should be, India falls far short. Gross capital formation in China accounts for around 42% of GDP. India's is under 34%. India needs to increase its investment share of GDP to develop its economy and increase productivity like China. With these statistics, it is clear that China still has the upper hand over India and can thrive more than it does in the future. However, the Indians will be able to outperform the Chinese if their leaders can do exactly what Deng Xiaoping did to China in 1980, opening up China's economy and allowing the 1.4 billion Chinese people to compete. Thank you for watching this video. You can check out our other videos that pop up on your screen. Bye for now.